global oil production has been increasing slowly, and now it's been peaking. It's not going to go down slowly. We're going to see a shark fin decline, and it's going to be cliff-like declines.
What do you get when you combine SD bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right, all right, all right.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Steve St. Angelo from SRSRoccoReport.com. Steve, thank you so much for joining us today.
Yeah, Elijah, it's great to be here.
All right, now the first topic I'd like to discuss is global debt, because you recently wrote an article talking about how global debt is actually growing nearly 3 times as fast as global assets. So what does this mean for the average person?
Well, you see, this is, we used to hear years ago for the U.S. government to print the money or add the debt. If we added $1 in debt, we've got $2 or $3 in GDP. And now we're adding $2, $3 in debt, and we're getting $1 in GDP. And so what that means is it's taking a lot more money printing to keep the economy going forward. So it is fascinating to see that our debt has increased from 50 trillion in 1997 to 233 trillion. And most of that increase has come over actually since like 2007. After the stock market crash in 2008, we went from like 149 trillion in debt, and we increased to 233. Now, what's fascinating, the debt actually increased 16 trillion in just the first 3 quarters of this year. Now, what's fascinating about that is our U.S. GDP, the nominal value, will be like about 20 trillion this year. Well, if we add one more quarter of debt, because it was only 3 quarters, it's going to be probably close to $20 trillion. The world added the same amount of debt as the U.S. GDP, which the U.S. is it's the biggest GDP in the world. So what that means for the average person is just working harder. They're becoming more in debt now, and a lot of the wealth is going to the 1%, Elijah.
Now, one of the things you talked about in this article is how wealth is related to energy, and that you see an energy crisis in the future. How does this all relate to the problem with more global debt than global assets?
Well, according to the Credit Suisse report on global wealth for 2017, it increased to the new record of 280 trillion. Now, what that means is they said it increased 6.4% this year. Well, in order to get 6.4% of more wealth, we have to burn energy. And unfortunately, if we go by the IEA, which is the International Energy Agency, they put out the information on world oil demand or total liquids. And according to them, in 2017, the increase of oil demand, I'm not talking production, it's about the same, but let's just look at the demand. Demand increased 1.6% compared to last year. Well, how does the wealth grow by 6.4%? It turns out to be 4 times. How does wealth grow 4 times if energy is only growing at 1.6%? Now, Gail Tverberg, she does an interesting a chart showing world oil supply growth since the 60s compared to world GDP. And what we see is it's like maybe 1% off, 1.5%. The increase of oil supply, which is also demand, relates to the increase of GDP. But now, as oil production, the increase, like let me give you an example. In 1975 to 1979, the world increased its oil supply by about 3.5% over that in those 5 years. Well, GDP increased about 4.1%. And then in 2007 to 2011, the oil increased only 0.5%, and global GDP increased a little more than 1. Now, we've added a little bit more oil with the shale recently. So again, it's 1.6% increase in demand. But we shouldn't be seeing a huge 6.4% increase in wealth. And let me say one more thing. How this relates to the United States. Even though there is this wealth happening, it's more. I think the GDP is increasing more in like China and other countries because China really increased their energy consumption. I mean, tremendously. However, if you look at the total U.S. energy consumption from 1950 to 2017, in 1950 the U.S. was consuming 35 quadrillion BTUs of energy. And it continued higher. It tripled. By 2000, the U.S. was consuming 99, almost 100 quadrillion BTUs. But guess what, Elijah? It peaked at 101 quadrillion BTUs in 2007. It's now, in the last 3 years, 15, 16, and 17, it's been 97. We're actually consuming less energy than we were at the peak in 2007. However, if we look at our retirement market has increased from 11.6 trillion to 27.2 trillion this year. It's more than doubled. It's like doubled in half. Well, how can our U.S. retirement market also double in value if our consumption has been about the same? So when we look at the wealth in the world, it has to be based upon how much energy we're burning. And what we're seeing, there's a huge disconnect, and the disconnect is the money printing and the debt. So really the values of these assets or the wealth isn't really going up. But what's going up, it feels like it's going up because of the money printing and the debt.
In the article also, you talked about how you see global oil production falling off a cliff soon. Can you expand a little bit on this?
Yeah, and soon is not like next week or next month, not even next year. In the whole scheme of things, look what's happened. It's been 10 years since the 2007, 2008 U.S. housing and banking crash. It's been 10 years. So when I say soon, I'm talking 5 to 10 years, and it could be a lot less. We could see this sooner as well. Now, the reason why I see a cliff-like decline in oil production, it's going to stem starting from the U.S. And the reason why it's going to stem from the U.S. is the U.S. has really increased oil production. It's almost doubled since 2005. And that is due to shale oil has come on the market. Now, unfortunately, shale oil has not been profitable. And there's been plenty of articles, graphs showing how no one really made money. And so what they did, this was a clever thing. They took investor money, they produced this shale that wasn't really profitable. And by taking the investor money or motivating them to pay them, these energy companies to produce the shale, they paid them a higher interest rate that they could get at the bank, 3%, 4%, even 5%. So they get this 5%, 4% every year. Now, what the shale oil companies have done is they've taken this money that they've gotten from the investors and they say, okay, I'll pay you back in 2024, 2025. So it's a Ponzi scheme. And I'll give you an example. Continental Resources is one of the larger shale companies in North Dakota, or even in like Oklahoma and Texas. Elijah, they had 165 million in debt in 2007. Before the crash in 2008, the U.S. energy industry was in pretty good shape. They didn't have a lot of debt. And Continental was only paying about 13 million a year in interest payment. Well, today, they're now going to pay 300 million as an interest payment, and their debt is $6.6 billion. Now, Continental's in big trouble because they have a lot of money that's due. These bonds that they've borrowed from the investors, they're coming due. So what did they do last month? They issued another $1 billion in bonds. They take that money, they pay off what the other investors, and guess what? If you were one of those investors that bought the $1 billion in bonds, you're not going to get paid back until 2008. So if we look from 2012 to 2017, the negative free cash flow of the U.S. shale oil companies, as well as the stock issuance, they're issuing more stock to pay for this. It turns out to be $212 billion. So in just these 6 years, they've borrowed $212 billion to pay for this. And now I'll conclude by saying this. Most of these companies, except for the Permian, they got to the sweet spots already. And now they're going to have to start moving out to the less economic wells further away. So that it's not as profitable. And so I think what's going to happen, a lot of these companies are not going to be able to make their interest payments, and they're starting to have difficulty making them now. I mean, $300 million is a lot of interest to pay in 1 year. So we're going to start to see the disintegration of the U.S. shale oil industry. And I will start to see cliff-like declines. We won't see, the oil industry, or let's say global oil production, has been increasing slowly, and now it's been peaking. It's not going to go down slowly. We're going to see a shark fin decline, and it's going to be cliff-like declines. So I see that because I'll conclude here. I've said it twice, but the oil price now, even though it's $63 a barrel, has the highest commercial short position in history. The commercials, we all know the commercials, as in the gold and silver, when the commercials really add the short positions, we know the price of silver and gold are going to come down. That's how they control the price. Well, in oil, the short positions now are a record 648,000. And let me just give you a comparison. When the oil price was 105 in 2014, right before it fell, the commercials only had 500,000 short contracts. They've got another almost 150,000. So I think when the stock market cracks, and I think the oil price could fall before, we could see the oil price really decline back to 40, below 40 in the 30s. And this is really going to hurt the shale oil companies, because I will say this, 2/3 of them, 3/4 of them this year are losing money. A couple are breaking even, and a couple are making money. So that's how I see cliff-like declines coming in the future. And there's a lot more information about global oil supply, Saudi Arabia, Mexico, Brazil, we could talk about in another interview, but I see that falling off swiftly as well.
So as for investing and those people who are concerned about their finances, how do you think this, the oil price going to, as you say, possibly even $30 a barrel will impact people's investments, and maybe in if they're invested in the stock market?
I believe we're going to see two things happen. We're going to see inflation. We could see hyperinflation, just like Venezuela, but that won't last long. That's not like a 5 or 10 year or 20 year. That's a couple year, 2-3 year deal, maybe even less. But I think we're going to see deflation of assets, stocks, bonds, and real estate. Because I've said this a million times, and I'll make this simple. And people, if they understand anything, this is an important concept to understand. Stocks, bonds, and real estate are based upon the economic principle of net present value. It's price to earnings. So you have to burn energy in the future to keep that stock price elevated. Actually, you have to have growth. You can't be stagnant because there's too much debt now. So even if the supply remains stagnant, then you start falling apart. But if the oil supply falls, then you start to see a collapse in the values of these assets. So a stock, bond, or real estate gets their value from burning energy in the future, where if you own gold and silver that you have purchased and put in your safe or in your pocket, that value came from burning energy in the past. That's why it's a store of value. And so going forward, when the oil price falls, it's going to gut the oil industry. When the oil industry starts to fall and become, then the oil production falls even further. Because as the oil price falls, Elijah, there's less that's profitable. What does that do? That means economic activity has to fall, right? Well, I mentioned the global GDP is based upon the increase of oil production. It has been. There's proof. So if oil production falls, GDP falls. Well, then wealth starts to fall, asset values start to fall. And so this is the realization. I'm not looking for the end of the manipulation. The manipulation of the gold and silver markets will happen, but it's going to be based upon when this energy starts to fall apart, because then the central banks, they can print money, but they can't print oil. That is when I see a lot of investors moving into gold and silver. And we've already seen this. We've seen this happen when the stock market fell from 18,000 to 16,000 at the beginning of 2016. There was only a 2,000 point drop in the Dow Jones, but we had a record inflow of investors in gold ETFs, and those were retail investors. But we did see a pickup in physical bar and coin for gold. Can you imagine when this highly inflated stock market, and we could talk about that for a minute, when that falls 5,000, 10,000 points, we could see the demand for gold will have never seen anything like it before. And that's when I do see the metals really moving up in value. They're up to their high quality store value.
Definitely. Now, as for gold and silver and the ratio, the gold-silver ratio, what is your perspective on that? Because a lot of people say that silver is a lot more undervalued than gold, and that the gold-silver ratio could go back to its historic ratio of around 15-1, or even further, some say, because it's been so out of whack for so long. When it bounces back, it may go below 15-1. But you recently wrote an article and said that the reason gold and silver are at the 70-1 ratio they are right now is because that's the cost of production of gold and silver, how much it costs to get them out of the ground. So where do you see that ratio going in the future?
Okay, and before I get into that, because we just spoke about the markets, I want to just throw in this one chart. Maybe some of the readers have seen this. It's the the New York Stock Exchange margin debt, and that's how much the debt that the traders have. In '99, in the tech boom, right before the crash, the amount of the NYSE margin debt was $40 billion. And then the markets crashed. It went up to $40 billion, and then it crashed. In 2007, it went up to $450 billion, and then it crashed. Well, you know where it's at now? It's nearly $600 billion. The margin debt now is $600 billion. I mean, just think about that. The tech boom was $400 billion, the margin debt, and it only went up to $450. It only increased $50 billion when we had the big stock market crash in 2008. Well, now it's at 600. It's 150 billion more than it was in 2007. So that's just another indicator to show you how leveraged this market is. Now, getting back to the gold and silver question, I used to believe in supply and demand, and a lot of people will continue to believe that supply and demand impacts price. Matter of fact, Jeff Christian and the CPM group, this is their main analysis, is supply and demand. I do no longer believe that supply and demand are the major factor that determines the price. It will, on a short-term basis, let's say there's a huge corn crop failure, the price of corn will skyrocket. But that doesn't skyrocket for 30 years. It skyrockets maybe for months, and then it comes down, or for a year. But if we look at the price of corn over 100 years, we will see that the price of corn is based upon its cost of production. And the supply and demand forces only push the price up and down over those 100 years, up and down off of that cost of production line. And it's a percentage. But if you average it out over 100 years, the price of corn is based upon its cost of production. And this is true for energy and metals, for commodities, lumber. Exactly. All the same. They're all based on that, even goods and services. But what they're basing now, the cost to it's the same with platinum. It's the same with copper and lead and zinc, palladium, all the same. Their prices are being based on what it costs to produce them. And so right now, the price of oil is now $60. I see the price of gold to produce it is between $1,150 and $1,200. Silver is probably between 15 and 17, maybe 15 and $17. So if you divide what it costs to produce gold by what it costs to produce silver, it is about 70 to 1. Now, here's what's interesting. Even though we're producing 8, 9 times more silver than gold, that's where people say, well, silver should be worth let's 10 times less than gold because there's almost 10 times more silver. Well, no. The parts per million in the Earth's crust of gold is 67 times less than it is silver. So a gold mining company has to move 67 to 70 times more ore to get that gold than silver. And if we look at the ore grades, I've been looking at the precious metal miners. The primary miners are mining silver now about 4 ounces a ton, where the gold mining industry, it's about 0.06 ounce a ton. So you divide those two and you get about 67. So this is the logic why they're basing the price of gold and silver on their cost of production. But the clincher is gold and silver aren't like most commodities. When you get copper, you produce it, then it goes in a home. Some of it's recycled, but it's used up. Natural gas, oil, they're used up. Gold and silver, even though silver is used as in industrial purposes and silverware, a lot of it is consumed. And it's not really, not a lot of the industrial silver is recycled, so it's lost. But there's still about 20%, 25% of silver that's saved as investment. It is the second largest. Actually, more silver is being saved than gold in investment. But if you look at it as a percentage of gold and silver in the whole market, silver is the second most saved or invested metal in the world besides gold. So they should be valued differently than just what it costs to produce them. And maybe we could talk about that towards the end of the interview.
Definitely. And I mean, so where do you see gold and silver's value? What do you see the values being based on in the future? Do you see it still being based on the cost of production?
No. And that's what I've been writing about. Everyone thinks that their home is worth $350,000, $250,000. Their retirement account is $250,000 or $1 million. But that's just a digital representation. And as we've known, after the crash in 2008, the real estate values plummeted. So there's nothing to say that those values will stay at where they're at. I believe they're inflated 50 to 75%. And more. So when the oil supply really starts to fall as the debt becomes unmanageable in the whole system, then all those stocks, bonds, and real estate values aren't worth it. They've been propped up. And so an investor who sees this market is starting to fall apart. And I mentioned to you it happened in 2016 already. We had almost record investment into gold on a 2,000-point crash. You don't need all the market getting into gold and silver. You just need 1%. 1% of investors getting into gold and silver will see their values. I won't give a number anymore because I don't know. Once we get to that point, Elijah, we could see silly cryptocurrency values. I don't know. Because we have to remember, if the market value of stocks, bonds, or real estate will continue to fall, why the heck would you want to be in there? Now, some people will not be able to sell their home. It'll get to a point where it's just sunk capital. A lot of businesses, a lot of these warehouses that we've built all over the place, you're not going to be able to sell them because there won't be the energy to run them. and we just won't have the economy to use them. So you're gonna lose that wealth, that asset value, but some will be getting out. And so that's when I see the price of gold and silver disconnecting from its cost of production. And it should have already, but unfortunately, the people in the world have been bamboozled by the central banks and Wall Street to believe to put them in stocks and bonds. It's a Ponzi scheme. And, again, just like Bernie Madoff, he was getting new people to pay off the old. We're seeing the same thing in the shale oil industry, the same thing in the pension industry. The pension industry is underfunded. It's the same thing. And the only way that works, Elijah, is if asset prices increase. You need increasing asset prices to keep this thing going. If asset prices fall, the whole thing falls apart. So I hope I answered your question.
Definitely. Well, Steve St. Angelo, I really appreciate you coming on today. Before we let you go, did you want to share with the viewers any last thoughts you had and remind them where they can find you online?
Yes, I have the SRS Rock Report website. We put out 2 or 3 articles a week. And I didn't mention this last time, but I'm also part of and a lot of people in the alternative media know about this. It's the Commodity Ed Network, and we're still getting ready to start it up. Anybody who's interested, either being a website that would like to have, instead of being Google having your ads, would you like to be on our ad network? Contact the Commodity adnetwork.com. It's commodityadnetwork.com. Also, any advertisers who are interested, please let us know. So I wanted to finish with that, and I am going to start my first YouTube video, Elijah. Hopefully it should be out tomorrow. And I plan on putting about 2 videos out a week because I think some of these concepts are better understood on a video platform. So thank you for your time.
All right. Thank you so much, Steve.